we are going to see an okay market in gold this year. Am I a buyer here? Yeah, gradually, but the run to gold starts very subtly. It's a walk, a fast walk, and then it's a jog, and then it's a fast jog, and then it's a slow run, then a medium run, then a fast run, then it's an all-out sprint. Once the gold run starts and that gold sprint, we get near the gold sprint and everybody's kind of hepped up on the precious metals, I think silver will rapidly catch up and the gold silver ratio will drop to, who knows, 30 to 1 rather than 85 to 1 or 90 to 1 that we've seen here lately. You don't have to bank the farm in gold because it is a non-producing asset. Yeah, we've done well on the uranium side. In fact, I need to do an update for my subscribers and say, hey, maybe we should take something off the table.
David, you said in a recent podcast that a number of high-profile billionaires are sensing the stock market bubble is about to burst. For example, in late 2023, we had the CEO of Chase, Jamie Dimon, saying we may be on the precipice of the most dangerous time the world has seen in decades. And then we saw Mark Zuckerberg selling $500 billion of Meta stock to build a 5,000 square foot bunker in Hawaii. But 2024 has kicked off with still more gains for the Magnificent Seven tech stocks, with Meta popping 20% in one day, Nvidia up 40% in just a month, Netflix up 20% over the same time frame. So has this spectacular run for a small group of US tech stocks surprised you? And how much longer do you think it could go on for?
It hasn't surprised me. Excuse me, it hasn't surprised me because the way the stock market is manipulated is just through buying through just a few groups of stocks that are the leaders, doing it with leverage, doing it in the futures market, for example, going in leverage on the S&P 500. But basically, to get the indices, you buy certain stocks, and that will make the overall averages look good. But if you look a bit deeper, look under the covers, you'll find that a lot of the general stocks that make up the totality of the equity market are not doing that well at all. And you look just at retail, and you see how much retail has been decimated over the last couple of years, from basically the 19 scare until present. Many of these corporate restaurants are closing their doors, either shutting down completely, but in most cases they're shutting doors of non-profitable locations. So there's a huge contraction in retail, be it the restaurant market, be it housewares, be it Bed Bath and Beyond, be it almost any consumable that really has done better in the past. The people are struggling for the most part. The middle class is getting wiped out. So no, it doesn't surprise me that they're still playing their games to make it look as if things are fine by manipulating a few very powerful stocks that move the indices. And at the same time, the reality of Main Street is much different than the purported numbers game at Wall Street. How long can it go on? And the answer is until it actually ends, which is a corny answer. But when you start to see the insiders exiting the market like you outlined, that's a big clue. Now we're getting closer to the end. These guys have got massive positions and they have to filter them out. They can't move the market too much because it'll crash their stock price. So they have to submit, paperwork to the SEC and exit their position again over time, not disrupt the market. So I think we are near a top, but the problem I have, and I've said this before, is that in a highly inflationary environment, the stock markets usually go up. Like you look at the Weimar Republic, you look at Zimbabwe, you look at Turkey, you look at some of these other stock markets, these go up and up and up. And it's a way to mitigate destruction of the currency by being in the stock market. The problem with that is, one, you're smart to do it from the aspect that you're losing less purchasing power from the stock market. But the truth of the matter is you're not really overcoming the true inflation rate because the stocks generally don't keep up with the actual destruction of the currency. So the only thing that did that in the Weimar Republic were gold and silver, for example. And Zimbabwe was the same thing. So How long can it go? I think it cannot go much longer, but I've been saying that for a while. I mean, I'll say it. It's funny and it's not funny. It's truthful, and I'll admit it. One of my clients that does regular consultations called, and he said, I heard you. You always have made sense to me, and you said, we only got a couple years left, 2 or 3 at the most. But you've been saying that for 6 or 7 years. And I said, you're right. I mean, really, it's very hard to predict the future. We know what the trends are, we know what the probabilities are, but to pick a point in space is extremely difficult. And then it depends how you measure it. I mean, back in the history books, and they're writing about this era, they might say that the 19 illness was the beginning of the Great Depression. Because from the overall longer term perspective, they'll say, look, all this retail shut down, all these small businesses shut down, jobs were really helter skelter because people that had $100,000 a year jobs lost them, and now they're working 3 jobs. So it looks like the labor force is higher than it was, but the guy that had $100,000 a year job that's got 3 jobs now is only making 70,000 a year working 3 jobs. So there's all these things to factor in. I'm not trying to make an excuse. I'm a student of history, and so I know, depending on how you look at it, and of course how objectively you look at it, we may actually be there now. We just don't see it clearly because we're looking at a rigged number on a stock exchange contrived by the financial money men that make a lot of the people, a lot of the institutions, a lot of the money, wealth managers, stockbrokers, commentators, news people look good because the stock market's still hitting a new high.
Maybe getting into the bunker building business for billionaires would be a good move right about now. But I wanted to ask you, do you think that this tech bull run is comparable with the dot-com bubble? Because on the one hand, you have a lot of vague speculation about a revolutionary new technology, which would be AI in this case. But on the other hand, these companies like Meta and Alphabet and Apple are massively profitable with strong balance sheets.
Yeah, I think it's different in that context. As you said, I agree, because a lot of these front runners on the AI are well-heeled, established, profitable, recognized, establishment, blue chip type of situations. And so they've got the backbone to ride it out, even if there is a couple of hiccups along the road. I was going to say that I think that the crypto world is similar to the tech bubble. I think there's so many cryptos out there that really don't have any substance at all that have gone by the wayside. I think that isn't over yet, even though it looks like the crypto winter is over and Bitcoin's back to 42,000 and change. The overall amount of cryptos that really have no true value are still sitting there being traded back and forth. Plus, with the regulators coming in stronger and stronger all the time, I think the shakeout in the crypto world hasn't really gone its full measure yet. I think there's more to see in that realm. But back to AI, no, I think you're right. I think AI is here to stay, and that it's not comparable to the tech wreck. I think the ups and downs in that market will be absorbed by companies that have the wherewithal to spend, several $1,000,000, and it's a mistake, but they've got millions more to back it up and correct and continue. Let's correct the problem and continue onward. So it's much different in my view.
I've heard you talk about the massive unrealized losses that banks have on their balance sheets right now. And in the US, that's been estimated at around $600 billion. And that's because, of course, banks loaded up on US treasuries that have since fallen in price due to the Fed raising rates. But I wanted to ask, do you see this as a potential destabilizer that could bring about this market crash that you've been forecasting?
Yes. Yes, I do. In fact, the Fed, although you won't hear many commentators say it, I think the Fed is scared because, they've made this what I'll call bridge between these mark-to-market bond sales and the ability to borrow against them at basically face value. So if you don't have to recognize your loss for another year, that stalls the facing the reality. And so why would they do that? Well, they do that because they don't want a bond market crash. That's why they would do it. And if they've done it once, what's to prevent them from doing it again? In other words, making a contract with the banks, the money center banks. If you have to sell your bonds to make, to get cash to pay your depositors that are withdrawing from the banks because they're going into the money market funds, we'll help you out. You can go at face value or near there by doing this. And a year from now, we've got to, you're going to have to mark to market or figure something out. And then a year goes by and say, well, economy still is as strong as we like. Let's just do it for another year. Or, I mean, there's so many things they can do with this rigged market that are uneconomic, unsound, misallocations of capital, and really put the pressure on those that basically run the economy, which is you and I, and play their financial games that I can't really forecast. But I will say with emphasis that if everyone had to tell the truth for one day in the financial markets and mark everything in the market, all the derivatives, all the bonds, all the zombie corporations, all the regular companies that are underwater and can't meet their payroll. I mean, if all that stuff was put on the truth meter for one day, you would have the most epic contraction in the money supply that you've ever seen in your life.
Mm. On the other side of the coin, people who say everything's all right and they're bullish on the market, they might say, although these banks are in the red on these treasury bonds, they can just hold them to maturity and then they'll get the principal back. And they'd only be forced to sell at a loss if there was some kind of liquidity crisis. And even in that case, the Fed would presumably bail them out. So what do you think about that argument? Does that convince you that everything's going to be okay?
Well, that's what I basically spoke about was, they are underwater if they tell the truth. They don't have to tell the truth. The Fed's making a special case where they can extend their, they don't have, if they have to liquidate, they don't have to. So if they've got to sell their bond at a 30% loss, rather than doing that, they're going to, get this loan to get the cash to make the deposit or make their depositors happy or whatever. On the other hand, as you said, well, look, the Fed will just be the buyer of last resort, and whatever they are, they'll just buy them up. And if you're, insolvent, the Fed will just say, well, you're too big to fail. Here's an injection of so much cash. We'll just give you pure cash, whatever. So could they do that? The answer is yes. Have they done it? Yeah, they've been doing it basically in one form or another for a very long time with the QE, Operation Twist, all these things that have been going on for so long to keep the banks liquid. And, remember during the Weimar Republic, the screaming was there's not enough money. The scream all the way up was there's not enough money. Well, of course there's enough money. They just put more and more zeros on it. It was the quality of the money that was the problem. So if they do what you outlined, there will be a point at some place where the currency is rejected. And so now you've got a 30-year bond that's basically a trade receipt for currency at 30 years, or a 10-year note, which is a currency receipt at 10 years. So sure, you hold them to maturity, and then you get this currency that's worth nothing. It's worthless. So in that interim between the time we're talking and that 30 years out or 10 years out, what happens? Well, the bond changes value based on interest rates. But eventually, the reality is it's not really worth anything. And so you could get in a situation where once the Fed goes to an extreme amount of QE, let's say, and starts reliquefying the banks because some are underwater, there could be, not would be, but most likely there could be a situation where the currency is rejected. And this is inevitable in all fiat systems. It's always happened in the past. The difference this time is it's the world reserve currency, so it's the US dollar. So it's the most trusted currency in the world. So if you think the dollar is in bad shape, just try looking at, the Zim dollar or, some of these other countries, Venezuela, Argentina. Look at the Aussie dollar. Look at, Look at the euro, look at other currencies versus the dollar. They're doing worse than the dollar is. Why? Well, in a very broad brush way, they're printing faster than we are. And so relative to the dollar, they are, destroying their currency at a faster rate than we are. So everyone's going to run into the dollar because it's safe, but they're still playing the same game. They're just getting to the waterfall a little slower than the other canoes, but they're going to go over the waterfall. So that's sort of my analogy, that I do expect that the US dollar will actually look pretty darn good until, it won't be a one-day event, but it could happen rapidly, where there's just a change in the markets, where somebody or some nation state or some sovereign wealth fund or some large hedge fund or somebody in trouble that needs to get cash to make a margin call or pay off a debt or whatever. I'm talking big numbers now. Does something that disrupts the markets, and that has a domino effect on the rest of the markets. Remember what I said a moment ago? If we ever put the truth meter out for one day, and everybody had to mark to market their true value of their businesses, the corporation, their bond, you would have a huge contraction. You'd have like the greatest depression in existence. They're not going to do that. They're going to keep funneling funny money into the system, because the funny money has to grow or the whole thing does collapse. So I think that's probably the best answer I can give you, that we are not going to be able to get out of it. We could deflate, which is the most morally correct, and reprice everything, and the value of the currency actually goes up or stabilizes. Or we can just keep printing till the market doesn't accept the currency. And I think the latter is the most likely case. But before that happens, these bankers are smart and they know we're at the end game, and they need to mitigate it. So the easiest thing to do is contrive some type of a crisis that they aren't responsible for. And once this crisis takes place, and it's pretty easy to mitigate their part in it, and then they can basically do their quote unquote reset and come into a new system that's basically digital based, probably cashless, and somehow or other mitigate, the debt situation to a large degree. And there's ways to do that. I'm still thinking about how they could or might do it. But one way would be, as Martin Armstrong has said, and that's just to do a non-pay selectively. The Chinese own a great deal of U.S. treasuries, and we're at war with them, so we're not going to pay that debt. So that wipes out, pretty good size percentage of the U.S. Treasury market that we owe to them. And there's a lot that can go on. I mean, we are in extreme circumstances that, again, you asked, how much longer, and the more extreme it gets, the less time we have. But it's gone a lot longer than I've ever imagined, because they're creative. They're very creative. And the BIS has even come out with like the banker's bank of cryptocurrencies. They want to perhaps have a crypto platform that might take in different ones or whatever. I mean, I haven't read it in a while. My memory's a little soft on it, but there is a move toward a new system, and the new system will not be this system. It will be different. But until that happens, you'll see the dollar probably do fairly well.
Well, it sounds like, if I could summarize what you're saying, you think we're heading towards some kind of crisis point, and we're getting there pretty quickly, or at least we're closer to it now than we were a few years back. And yet everything seems to be hunky-dory. No, I mean, the latest US employment report showed 353,000 jobs were added in January, which was twice as many as forecast, even by mainstream analysts. And US fourth quarter GDP as well also beat estimates, showing 3.3% growth with consumer spending and investment solid. So how do you kind of reconcile this quite negative, bleak outlook with what are very rosy, positive statistics?
Well, it goes back to what I said earlier. It's the guy that lost his job for 100,000, and he takes 3 jobs and is now making 70,000. That shows out as a gain of 3. or a gain of 2. 1 loss and 3 gain is 2. And that's the situation for a lot of people. So there's that. The other one is they always come back and adjust these things. You never hear the adjustments. When they do a seasonal adjustment, they do the death rate adjustment, they adjust these things. They're almost always downward. And what they're not really telling you is what's more important, and that is, what's the average viability of the average worker? Are they richer or poorer? And basically, from the best trusted data that I trust, the average American has gone down in wealth since about 1978. Now that sounds ridiculous because that's going back to when I was a young man, and yet even though you might be making, I don't know, 30,000 then, and you're making 100,000 now or 120 or whatever it is, the actual value of that money is less than it was back in 1978. So even though the numbers, I mean, and I don't like using this, but I will. I mean, there's an adage that liars figures and figures lie, and you can pretty much mitigate whatever you want with the right statistical analysis that may or may not be totally truthful. It may be skewed deliberately to make things look better than they really are. The main thing is to ask everybody in your neighborhood, everybody in your county, are you better off now than you were 2 years ago? And if the majority says, yeah, well, then those statistics will probably be believed. And yeah, I'm off. I'm wrong. I'm missing something. On the other hand, regardless of the statistics, put them to the side, just ask that same question, and everyone says, no, I'm about the same, or I'm slightly off. I'm well below where I was. I don't think I'll ever get back to where I was. I don't think I'll ever get that high-tech job back. I'm worse off. And that's the bottom line. That's what the vote is. Then that would ascertain without any numbers whatsoever at all what the truth is. And that's what we're seeking. We're seeking to make a determination of what's the true state of the economy. How good is it really? How bad is it really? What's causing this? Can we change something? And if we can, what would it be and how do we do it?
Let's change topics slightly because we've been hearing news reports about congestion at important trade routes. First, at the Panama Canal, which has been narrowed due to drought, and second at the Suez Canal, which has seen traffic drop by around half due to terrorist attacks from that Houthi group in Yemen. And so obviously this means higher freight costs due to inflated insurance premiums and diversions and waiting times going up to receive products and parts. So do you see this story as potentially being an important factor in leading to a resurgence in inflation, or are you not paying much attention to that?
No, I do. I think that it is a factor. Anytime you got an added cost, the consumer never asks or seldom asks, well, was it a tariff? Was it an import duty? Was it an extra transportation fee? All they know is it costs more. That's it. They just look and, oh my God, the bread's up another 50 cents from a week ago or whatever. They don't really take the time, probably don't have the time. Say, oh, it's because of shipping rates or whatever. But of course it does. Anything that adds to the cost is felt in the average person's pocketbook. So if you're XYZ machine company and you need your ball bearing shipped and it goes through the Suez Canal and you just got a call from your chief logistics guy that it's going to be a 2-month wait, and your inventory is really weak and you're probably going to have to lose some clients or put them off and see if they'll wait that extra 6 weeks to get their product out of your machine store, then what do? Well, most people will up their prices to mitigate the loss of business that they're going to see in the future, and also know that their shipping costs are going to be increased. So these things kind of compound. Most people don't think about the compounding effect, but they have that. Now, once they've gone up in price, are they going to cut prices if things go back to normal? The answer is a few could, and they might, but it seldom happens. Once they have set a new floor on a certain good or service, seldom does it come down. That doesn't mitigate the truth of human ingenuity. I mean, a laptop today that I have is I don't know what, 100 times better than the one I had when I was, you know, out of college and bought my first laptop. I don't know. I know it's much better. It's 100, it's 1,000. I don't know. What I do know is that the price is approximately the same and their product is multiple times better. So that shows you I'm getting more value for the same money. And that's true. And that's the way things work in the real economy when it's free, that you continue to improve across the board. And therefore, the money is actually a slight deflation where your money actually purchases more at the end of your life than it did at the beginning of your life. But that's in an honest money system. When you have a print as much as you need, if somebody goes broke, print it up and make them good. If somebody's insolvent and they're a big boy and they're a friend, bail them out, and on because of all the misallocation and not letting the free market work, where if you're a loser, you lose. If you did a product that wasn't bought by the market, you're out of business. And that's a true free market. And without that ebb and flow, that up and down, that balance that's required for a strong economy to continue to move 2 steps forward, 1 step back, 3 steps forward, 1 step back. All those 1 step backs are the market clearing itself of misallocations and ideas that didn't work or have been usurped by better ideas that work better. And then the market continues on where we get a steady increase in productivity or, better economy, higher wealth per capita, all that stuff. But if you keep rewarding failure and you keep rewarding failure more and more and more and more and more, and let me say one more, which is what we've been doing for the last few decades, then you're in a state of almost being stagnant in some areas. But, the American people and others, it's not just Americans, are so inventive, and so many people that are very entrepreneurial do not really pay attention to the money because they're passionate and they invent something that the market wants. And no matter what game you're using for units of account, dollars in this case, or pounds, or euros, or Aussie dollars, or whatever, they're playing the game so well that they don't care about the currency units because they got a bigger purpose. And so you do see innovation. You do see, things that would be positive about in the economy. But I would submit for your consideration that if we're in a better economic system where there was a lot less misallocation of capital and these better ideas had, let's say, a better chance of coming to the fore, then we would have a better economy. It's just very, very simple. If you're, in a situation where you have an illness, that illness is going to hold you back till you get rid of it. Yeah, you could use that as an analogy for the economy. The economy is very sick, and we got to get it well before we can really be healthy. And we just haven't let that happen for a very long time. And the longer you're ill, you either somehow or other start to get better or you die. And that's sort of the question you asked me earlier. I didn't use that terminology, but are we going to be able to do these loans and, reprice the long-term debt and all this stuff that we imagine that the Fed could do and come out okay and stay healthy? Or are we going to die? And I would suggest we're more toward death than most people realize. And yet, as I said earlier, I want to make very clear that there is a new kid on the block, meaning a new method to run the financial system. And even with that, the reset and the banks are all in collusion doesn't necessarily mean it'll work. They might, make the proposal or make it mandatory or give you voluntary adherence to the new program, and yet it's rejected at a level that's not sustainable for the banking system. I mean, the banks have a problem now without changing the system of how many people are unbanked. I mean, these are people that don't have a bank account, and it's in the billions. I think it's 1.4 billion worldwide. I forget the number. I think that's right, but you can look it up. But they need to get everybody in the system. They don't want anybody left behind. So there's a lot that's going on behind the scenes that isn't really voiced that often that could be detrimental to the implementation of the new system that could make it difficult to employ it.
Hmm. We're going to move on to talking about the topic for which you're most famous, which would be precious metals shortly. But just one last question on macro first. I want to get your take on rate cuts because Jerome Powell said last week that cutting rates at the next meeting in March was not in his base case scenario. So now there's a lot of speculation about is the first rate cut going to come in May, or are we even going to have to wait until July? Do you have any opinion on that? Do you think it's important?
That's a tough one. I mean, I said earlier, because I was of the belief that they were going to keep increasing rates until something broke. That was my statement. And there were a few along with me, not too many, where the majority in the alt financial media were saying that the Fed could never raise rates above 3% or 3.5%, and they could raise them even higher. But Powell knows he's kind of on that fine line that if he raises higher, it'll be detrimental. He wants to raise them just high enough to get their measure of inflation back to 2% or thereabouts. He's even backed off on the 2%. So it is important. I mean, the cost of money is important. That's how we operate this debt-based system. What is the future value of money? I mean, if you do an analysis on a mine, for example, and maybe 10 years before it's actually built and producing, 100,000 ounces of gold on an annual basis, you do an analysis and you do the net present value of money or the present value of money. Use the present value, and then you project a certain inflation rate and what it's going to cost in the future. And that's how all these analyses are done, is based on a depreciating dollar. And it's a fairly good methodology because that's the reality, that inflation's here to stay until it ends. But it can't give you an overall, what will it do in the big picture. If you raise rates high enough, you'll crush the economy. It can't be done. Will it matter if it's in May or July? I don't think it will. When they start to lower rates, I think that's the more important question. Because once they do, then people like me that know what happens from past conditions will be sounding the alarm that they're giving up on the value of the dollar, and they're going to let it basically go more towards zero than it already is. In other words, the destruction of the currency I've mentioned so often. So if they start to flood the market with more cash and lower interest rates and start to go in more of a QE stance, then that will be great for the bondholders. Their bond values will go up because interest rates are going down. And that will put more cash in the system. More cash in the system means higher inflation, not less. But the inflation numbers will probably be adjusted, showing it looks good for a while. But it's a mess. They really can't, there's no way out that I know of that makes sense, that's really beneficial to the system at large, other than a lot of pain. And that would be what I said earlier, get the truth meter out and let every corporation out there that's a zombie corporation fail, that all these bonds be paid off for what they are. Remember, in a complete financial collapse, all the wealth is there. None of it goes away. All the fields of wheat and corn and all the oil fields and all the churches and all the buildings and all the empty office buildings and all the banks, all the houses, all the factories, they're all there. They don't blow away. It's all the same the next day. What happens in a financial collapse is there's a huge repricing on what these assets are actually worth. And if you've borrowed $12 million on a house that's worth $1 million, what's the house worth? Well, it's worth $1 million. That's what it's worth. And the market, if it's allowed to, in a free market, will determine what that price is. And now you can basically reboot, I'll say, not reset, reboot, and come back. The problem is that it's so massive to do that. There'd be so many losses, that there'd be so many corporations out of business. There'd be such a huge unemployment. There'd be so much pain that the government knows that it's easier, better, and they aren't blamed as much if they just let the currency destroy itself. And hopefully it destroys itself on not on their watch, is what I'm trying to say. So, Bernanke got away with it and he moved out, and then Grandma Yellen came in, and then you got, Powell in there, and maybe Powell will exit in a couple of years. And Powell was so wonderful. He got inflation down from a high of 40 years down to 2.5%. Oh my goodness, the Fed's so wonderful. But the truth is, we are facing Mother Nature's law of economics, and that is high unemployment, uncertainty in the system, viability of the dollar in the longer term, trade wars, an energy situation that's good and bad. In other words, on a contracting economy, there's plenty of oil, but in a robust economy, there's not enough. A lot of things are taking place simultaneously that all integrate together. All these points, all these dots actually connect in a lot of ways. And so I might sound, I'm sure to some people they've turned me off a long time ago, and that's fine. But the truth of the matter is we don't have a lot of time left. In fact, I think this year is the year where most people realize that things won't be as good as they were in their 10 years ago for most people. I mean, the entrepreneurial class, and some people have bought the right stock or played the bond market correctly or whatever, they'll be fine, but they're few and far between. The basic people that work for a living, that don't have any stocks, don't know what a bond is, that just have a bank account and have to pay their bills, those people, the vast majority, will be worse off than they ever have been. And they can't figure out why, because they just got another raise, but that raise does nothing relative to what groceries cost, that type.
And yet, despite your withering criticism, most of the participants in the market view Jerome Powell as being one of the most hawkish, heads of the Federal Reserve that we've had in a long time, since Volcker. And in fact, he was on 60 Minutes the other night saying that for him, the most important thing was integrity. And we've seen over the last few weeks that the dollar index has been ticking up. And that, of course, has implications for our friend, the yellow metal gold. And its price right now is 2020 per ounce. And David, when I interviewed you 9 months ago in April 2023, you said at that time that you were playing things safe and just building up cash, because you said a market crash would likely tank gold and the gold stocks too. So despite being obviously long-term bullish on gold, at that moment you said you were just building up cash reserves in case a market crash came. So is that still your position now?
No, gold's made a pretty good bottom, a new base, I should say, around the 2000 level. It might get pushed down below there to 1950. I don't think it's going to do much worse than that. So we have a new base, and that's $2,000 US, and that is a nominal high. And so we've got a base to build off of to go up. The gold stocks have not performed, so I'm not worried about building cash in the gold stocks, although there are some buys out there. I just wrote in the last Morgan report what part of the gold equity market you really want to be in. There's one area that's far superior to the rest. And if you're going to want to make money with leverage in the gold and silver markets, that's the arena you should study and really be invested in. So I'm disappointed in silver, but yet gold is chugging along, doing fairly much what I would expect in this environment. I mean, the dollar, as you said, isn't really that weak. And in dollar terms, it's done fairly well. Will it go higher? Yeah. I said in the opening issue for this year, I expected gold to go up perhaps 10, 13%. Gold was up 13% last year. So if we did a repeat of that, you can add 13 to 2000 or 2100 and get your number. I said I didn't see it much over 2500 for 2024, unless one of these black swans does take place, and then there's a panic in the gold or a rush in the gold. The problem really is people are not as familiar with gold and silver as far as an asset protector. And there's so many choices. I mean, you have a choice in crypto, you've got a choice in ETFs, you have the ability for the general retail investor or even institutional investor to buy commodities by buying stocks. That's where the SLV and the GLD come in, because there are only some of these regulations are that you cannot buy a commodity. So they make a commodity backed by a share certificate, and now you can. So there's been a lot of dilution in the gold and silver market as far as products that really aren't gold or silver, but represent it. You know, like a beneficial statement, you're the beneficial owner of gold. It's only been sold 10 times before, but here's your certificate. So the metals really haven't been given their fair share of the ability to represent the destruction of the currency as they have in past terms. There's a lot of things working against them, including, if you study it enough, a management of the market for a lot of the time. And I brought that out of my book, The Silver Manifesto, using the Sharpe's ratio, which is a good way to prove if something's a random walk or not. And the silver market and the gold market are definitely not a random walk. So should you hold gold? Yes. I think the main thing that, I probably didn't emphasize enough, but I have in the last several interviews, and that's, have enough, but not too much. You don't have to bank the farm in gold because it is a non-producing asset. And if you have, one of these entrepreneurs that comes up with something that, helps the health industry or helps food industry or whatever, makes your life better, go for it. And that's why, I specialize in like 20% of your wealth. It should be in these resource stocks and split gold and silver in this manner. And with the other 80%, find another somebody or somebodies to help you with the general equity market, because I don't have time to look at it that much, or real estate, or a business, or bonds. But I'm not a big bond fan, as you know. So I think that we are going to see an okay market in gold this year. Am I a buyer here? Yeah, gradually. I'm not getting ahead of myself. I bought platinum over the last couple of months. I think it's the safest buy right now. There's not
Let
very
me
many platinum
sorry,
ones.
let me stop you because we'll get
Sure.
onto platinum shortly. I'll just say there'll be a lot of happy quacking from the Scrooge McDucks in the comment section, who last time, I'll tell you, were indignant that you had suggested that it was not the moment to buy gold. They're very upset about that, but I'm sure now they'll be very content. And I wanted to also ask you about a comment that was put to me by Adrian Day, who is the manager of the Euro Pacific Gold Fund. And he said to me the other week that the coin retailers that he speaks to are all saying that demand is pretty much flat among their clients, and that gold ETFs are seeing outflows as well. And according to Adrian Day, he says the gold price has run up almost entirely because of central banks globally stocking up on the metal. So do you agree with his analysis? And do you see this factor of central bank demand driving the gold price still further? Or has this story pretty much finished playing out by now?
Well, I sure love to see the data for 2023, because we know in 2022, it was I would also agree that most of the buying has been central banks. Remember, I know I said it on your show or not, but I said the run to gold has begun. But the run to gold starts very subtly. It's a walk, and then it's a fast walk, and then it's a jog, and then it's a fast jog, and then it's a slow run, then a medium run, then a fast run, then it's an all-out sprint, and everybody's going as hard as they can to get in the gold market. But that's at the end. If we're at the beginning of the next move up in gold, it starts subtly, and the subtlety is who's buying, and it's a smart money, and they don't announce it. You and I announce it. They don't announce it. It's Reuters comes out with an article and says, so much gold has been bought by the central banks this year. But the central banks don't put it out in any press releases. It's on their balance sheet. So if you know how to look at a balance sheet, you can see it. But So yeah, I would agree. I think that now is it going to pull back here, and there's um, less buying by central banks? That's a hard one, but my take is no. That the banks know that gold is the money of last resorts. Gold is an establishment monetary metal, even though they don't recognize it publicly, they recognize it privately. And because of that fact and the way that the economy is going on a global basis, with all we talked about, with uncertainty in the bond market, with zombie corporations, with the Suez Canal, with Panama, with war, with all that's happening, are we in a more certain world or a more uncertain? Well, we're in a more uncertain, which means that if you got to mitigate a problem, you want to have more gold, not less. So my guess is that you'd see more gold buying, even if it's just the central banks. Um, and then at some point, you'll get the momentum traders in there. The algorithms will kick in. Gold's gone up this much on this much volume. The algo says it's time to buy. You buy, that feeds that forcing function. Another algo says, yeah, we're at our buy point. Yep, there's big volume. We'll buy more. And you get gold to go up to 2,200 US. And it stays around there and builds another base. Kind of goes like a stair step, up, up. And of course, it goes up and down. We all know that. But overall, so again, I think it fits my overall outlook for this year. Um, I think there could be a rush to gold for the retail investor if something big happens in a banking system where there's, a bail in or something that really scares them. You could see a temporary blip in the gold, but gold just doesn't have uh, the long trait, well established vote of confidence it had in the past. I mean, if you go to India, it does. Go to South America, it does. If you go, to Asia, it does. But if you go to North America, Australia, Europe, it doesn't. It's like a temporary hedge, and I can always get into an ETF if I need to. It's only like people that have seen generational wealth destroyed. So that mindset is bifurcated. It used to be more universal. And, going into my generation, really, I mean, when the silver left the currents, left the circulation in 1965, I mean, almost everybody over a couple, 3 years realized something's wrong here, but we don't really worry about it because the economy was relatively strong. And then, when gold when it was closing 71, and Nixon said the dollar will be just as strong as it ever was. Most people bought into that one. There's only a few people that said this is going to be the end of this is the beginning of the end. And we didn't know the end would be 50 years plus out, but that's where we are now. Some of us thought it was nearly over 1980. I was one of them for a while until Volcker stepped in and had the ability to put interest rates at a huge real rate of return.
Yeah.
The inflation was at 13%. He put interest rates at 20. You had 7% cash in your pocket, a real rate of return, 7%. So I know that the best performance from 1968 till now is a 25% weighted in gold. And that's a lot. That's a lot more than I recommend. I recommend 20 at the most, but 10 is good for most people. And yet, how many people in North America have a 10% weighting in precious metals? And it's precious few. But I probably overtalked it. But if we go back to having a portfolio that helps the economy, you'd still want to weight some in precious metals, as I teach. And yet, a lot of it would be toward, the general economy, these entrepreneurs that come up with great ideas, better ways to build things, better ways to grow things, better ways to build health, better education. I mean, all this stuff that's really worthwhile, that you can have a lot of your funds in those situations.
Yeah.
So,
When it comes to central bank buying of gold, I saw an interesting statistic from the World Gold Council, which said that 6 in 10 of the central banks that they surveyed were planning for gold to make up a greater share of their total reserves going forward. And you also tweeted out an article recently, and the headline was China's central bank added 225 tons of gold to its stockpile in 2023, yet the share of gold in its overall reserves remains minuscule. So I suppose that all suggests, doesn't there, that there is some more space for that demand to keep growing going forwards.
Oh, absolutely. I mean, if you go back, no one knows this number, and I don't think anyone will ever be able to determine it. But purportedly, back in the late 70s, 1980, about most investors had 5% in gold, and now it's less than 1%. So if it went back to what it was, I won't say historically, just in the last run up, it would be. Sorry about that. I didn't know I had this thing on. It would be a five-fold increase. I mean, the other way I looked at it, I didn't say it on your show, but there's like $5 trillion kind of this sloshing around out there with really no home, sitting in the money markets and kind of waiting to invest. If you take 1% of that, that's $50 billion. Total silver market is $25 billion. That's 1 year's mining and recycling. So $50 billion, 1%. Do you think in the next financial crisis that 1% of that money wouldn't seek silver? I think it would. And so 1% going into the silver market basically represents 2 years total silver supply. What if you ran a widget business and you had a demand that came in that you needed 2 years worth of widgets and you only had 3 months on the shelves? What would that do to the price?
When it comes to picking gold stocks, you've got the explorers on the one hand that are struggling right now with the cost of capital due to depressed stock prices. And then on the other, you've got producers that are seeing their margins compressed due to higher costs of inputs like labor, electricity, equipment. So are you at liberty to tell us, maybe in vague terms, where you're looking in the gold
Yeah, we've been in
market?
the royalty companies
Right.
basically from the beginning. I mean, if you bought my favorite gold stock at the top of the market in 2011, so gold in September 2011 was about 2,000 an ounce. And today we're about 2,000 an ounce, 12 years later, 2023, 2024, 13 years later. But if you'd bought my favorite gold stock at that time, you'd be up 400%. That'd be like gold being at 8,000 right. So these people that say that gold outperforms gold stocks and on aggregate, you mush them all together and average them, they're correct. But if you're really not a stock pick, you're not correct. In fact, my favorite silver stock in that same category, when silver's at 50, I forget the number, but that stock was X. And it went way down when silver got crushed. But right now, and over those 13 years, that stock's still up like 40 or 50%. Would you be like silver being at $37 right now? So you can make more money, if you call it fiat money, in the miners or really the royalty companies. And I just did that on this last letter because I don't want my people to do anything but have a great life and be able to relax with their investments, not have to think about them too much. Let me do that and just put big money in these bigger companies and just sleep well at night. The problem is that the whole industry, since I was a kid till now, focuses on the juniors. And everyone loves that story. First of all, I think this is my personal perception, personal opinion. I'll voice it. Could be wrong, but I think a great deal of people get kind of a joy out of having a lot of something. So if you buy a stock that's a 5-cent stock and you buy 50,000 shares or whatever, they feel important because, their banker has 50,000 shares of IBM or something. Well, I've got 50,000 shares of a gold mine. And that psychology has been played on for a long time. And it's a way to lose a lot of money. The junior industry is important. In fact, it's imperative for the industry at large. Well, for every company that's out there, it's 1 in 4,000 or so that actually finds a mine that's mineable. So your odds are really against you. And the people that advocate the junior industry have every right to do so. I mean, I'm free market. You can say whatever you want. I mean, I don't think you should lie, um, but these people that advocate it do not buy junior companies, and that's what they basically say. At least that's how I hear it. What they do is they finance them. There's a whole world of difference between financing a junior mining company and buying the shares in the open market. Huge difference. And because of that huge difference, these people that finance these juniors usually do quite well, extremely well. Whereas the general public that's trying to find that next, XYZ mining stock that's going to go from 12 cents to $12, good luck. It does happen, but it's very rare. But they're told that story over and over and over. Plus, they have 50,000 shares of it. If it goes to $10, you got $500,000, man. They're going to send their daughter to the best college ever, this kind of stuff. I mean, it plays on people's dreams and naivete, I think. I do have penny stocks in my portfolio, but I teach people to bet a little to win a lot. Bet what you can afford to lose. I've had some great story stocks. In fact, I have one that pretty much given up on. I don't know. The idea is very sound, but it's just been beaten up so bad. I don't think it'll ever come back. The initial offering for the financiers was at 25 cents. I think the stock's at 2 cents now. So even those people that held from the beginning are down 90%. So to come back, 90 times, is highly unlikely. I mean, I'm sure, I don't know every stock out there, believe me. I'm sure there's an instance or two where something went and came all the way back, but that would be so rare. But I'm just holding it because I got nothing left to lose, really. And I also want to see if by some act of fate that they do actually become viable. It's a great idea, and it's actually a benefit to the mining sector. It's basically replaces heap leach cyanide with a inert substance that basically yields a higher rate of return than cyanide does, and it's inert, as I said, so it doesn't harm the environment at all. So it's really a great project. It's just been hasn't been bought up or brought up by the majors. We need a Newmont Mining or Barrick or maybe not those two, but somebody big, someone that with a lot of clout in the industry that says, hey, we're employing this method on all of our heap leach facilities. We're doing a pilot test on one of our heap leach facilities, and we've tested it out for 6 months now. And honest to God, it works better. It's faster. It's more environmentally friendly, and we're ESG like you won't have it. We're the biggest ESG gold company in existence now. We don't use any cyanide at all, and that would go a huge, long ways in today's environment with Blackstone, BlackRock, State Street, all these entities that have all this control over the system at large, and they're pushing the ESG so hard. So it's a great story, but again, so I can be wrapped up in them. But if you follow my rules, you bet a little to win a lot. You didn't overdo it or that type of thing. So big money goes into big companies, royalty companies, medium money into medium company, medium royalty companies. And if you want to speculate, go ahead, but do it with your head on straight. And the other thing on the juniors is if they really start to move, you can reevaluate them and make a determination then and there. And I give you an analogy of a horse race. If you start at a horse race and you put your bet down and the gun goes off and you're 30-1 shots the back of the pack, dang, I should have known better than take such a long shot. But if the gun goes off and the race starts and you get to watch the race all the way to right before the finish line, and that 30-1 shot's in the fourth place, you might make a pretty big bet on it because it's got a pretty good shot coming up one more horse and making you a lot of money. And that's what you can do in the junior industry. If they do make a discovery or have a material change in their business, it has to be reported. In fact, they usually shut down trading for a few days and then they reopen. And if you read that announcement and understand it, you could see that horse bet that was, 20 cents at the beginning, now it's a $2 bet. But a $2 bet has a hell of a lot better chance of paying off to 8 than it did when it was 20 cents because it was a 30 to 1 shot. I hope I'm making sense on this analogy. So you can say, you know what, I can bet now because their discovery and do a back of the envelope and say, you know, that stuff, the amount of gold they discover is worth about $50 a share. And the stock just went from 50 cents to $5 and make a better bet. You don't want to over bet, but you can do an analysis and say, now's the time to get it. But wait a minute, David, I could have bought it at 50 cents. Yeah, but you bought when the gun, before the gun went off. I'm buying with the race really getting down to where it counts. So anyway, I have done that. And it's kind of fun because most people don't approach the junior market in that manner.
Mm. Well, I too have a sob story when it comes to betting on penny stocks. It was a helium mining company that's fallen so much that I would actually, if I sold it, when you count the transaction fees and the foreign exchange fees, I'd be at a net loss. So I've just got to leave it there in my portfolio as a tragic reminder of not taking stupid bets on companies with no profits. But David, before we wrap up, you're affectionately known by people in the industry as the silver guru. So I'd be remiss not to get your insights there. You've already spoken a little bit about silver, but I wanted to read a quote from you, which I thought was quite a impactful one. And it says, silver is probably one of the best legacy investments you can make. So what's the elevator pitch then on silver right now? Why does it merit such a strong statement that it's the best legacy investment you can make?
Well, first of all, it's a forward-looking statement, so I could be wrong. But the legacy investment has to do with the conditions that we have. And that's, anytime you want to drive a market to a high level, you corner the market. You want to drive a stock up like GameStop, you basically buy up all the shares and you don't sell, you just hold. So you buy more. So any new buying raises the price, even if you're going against the hedge funds on Wall Street. And so those kids, generally speaking, really took it to the hedge funds on that GameStop. Same thing in a commodity, and the best known in the silver market, of course, is the Hunt brothers. And we all know how that ended. But if you have what's called a natural corner, that's even more powerful. A natural corner means that just the natural state of the element is so imperative, so important, that it gets bought up just for the natural state of the world economy, that the market gets tighter and tighter and tighter. And that's where we are with silver. We're in a situation where the solar industry is going to increase over the next 2 years and then flatten out. And that's the projection. No one knows the future. It could go higher, it could go lower. But I think that the projection's pretty accurate. So you've got all this new solar that requires silver, and then you've got all these higher tech items, like the average car uses a lot more silver than it used to, not counting electric vehicles that use more than an ICE engine car. And there's more inventions, there's more patents for silver every year than there is for anything else other than oil. So you just have a huge demand that won't go away, that there is no substitute. Most people, I'll substitute. If you want to substitute silver, you can substitute gold, platinum, palladium for it in a lot of cases. You could substitute aluminum, but usually, or copper, but they have different life forms. They do not do what silver does. And so there really aren't any substitutes. There's nothing cheaper than silver that does the performance that silver does. So the legacy is that even if I'm wrong now, which I doubt, but if I am, and you have the wherewithal to wait 10 years, barring that things stay relatively the same, then it's almost a no-lose proposition. I mean, right now, silver's basically under the cost of production at $22.50 an ounce. A lot of the silver producers are somewhere in the 23 range here. Yeah, about 22.50. So if you look at like First Majestic, their costs are 26 an ounce. This is my work. It's more than all-in sustaining costs because I took their balance sheet, and also this is from Steve St. Angelo, and also their income statement. So actually it's a more accurate, but going back, maybe 6 months ago, 26, 24, 23, 23, 22, 21. And those are the 1, 2, 3, 4, 5 top silver producers. So if you're buying it at 22, and if you buy it at spot, which you can't as a retail investor, you're going to have to pay a premium. But hypothetically, if you could buy it at spot, buy it off the exchange at spot. You're one of the better silver miners in the world. And you never had to get a permit. You never had to do a scoping study. You never had to do a preliminary economic assessment. You never had to do the study of the kumquat tree with the uji bird being environmentally, detrimental. I mean, I didn't do any of that stuff. And that's why Warren Buffett was probably the best silver miner on the planet. Because when he bought 130 million ounces of silver, he bought it under the cost of production. And he just had a minor storage problem. So that's why I say it's a legacy investment. That and then of course it is a monetary metal, although some people argue it isn't. I'd say it's both an industrial metal and a monetary metal. I'd be kind of stupid to say it's not an industrial metal when over 55% of its use is industrial. But nonetheless, the word money and the word silver is synonymous in the Romance languages. And a lot of people still look at it as money, like in India particularly. So once the gold run starts and that gold sprint, we get near the gold sprint and everybody's kind of hepped up on the precious metals, I think silver will rapidly catch up and the gold silver ratio will drop to, who knows, 30 to 1 rather than 85 to 1 or 90 to 1 that we've seen here lately. So I'm so bullish, but and the last thing is, it just doesn't make sense. I mean, the enigma of silver has always been there, but you see all this solar demand. You see silver coming out of the ETFs rather than in. You see institutional investment being almost nil. And that's surprising because these guys run the same algorithms as everyone else. It's as if someone just, gave out a couple of phone calls from the main trading desk at the Federal Reserve and said, whatever you do, you can't buy silver. Don't even try. We're going to lose your account here if you do. I mean, I'm making this up and I'm doing it with a bit of tongue in cheek, but it is interesting that you don't see these big moves. And the commitment of traders reports look odder and odder as time goes on. So just a word about platinum. I mean, platinum's got all the attributes of silver as far as how scarce it is, but it doesn't have the industrial demand that silver has, but it's getting there and it's very, very scarce. It's 15 times rarer than gold. And it's very near or under the cost of production in almost all cases. So as far as safety is concerned, I look at it as being a safe investment on the metal side for actual metal or an ETF that I could.
Yeah. Well, I know that you've been bullish on platinum, and last year, actually, I interviewed an expert on the topic, Dr. David Davis, who's written numerous reports sounding the alarm bell when it comes to South African production of platinum. And he says that production, well, about 80% of it comes out of South Africa, and that the miners are being strangled by power grid problems in the country. But the price of platinum since that conversation has performed atrociously. It's down from $1,100, which is its 52-week high, to below 900 now. So why do you think it just keeps going down and down? Do you think it's this substitution with palladium that's pushing it down?
Well, that was part of it for a while, but that's gone away. It probably went away a year or two ago. In fact, I wrote about that in my report. They're going to, in fact, I made a big score by being short palladium, long platinum. Platinum basically went flat, but palladium went from the high of 3,000 down to being almost par with platinum. So that spread trade worked out really, really well. But I think it's the ministry of truth. I mean, I don't know what to believe in these financial markets anymore. These numbers are numbers and people buy into them and we don't really have much else to do. But we've done a couple really big write-ups on platinum over the last couple of years. And we revisit it from time to time. And with the power outages that are, in South Africa and societal unrest and the labor, costs of mining, I mean, it's very surprising to me that it's not higher. But, the derivatives markets are what you see the price of. You see the price of a piece of paper platinum and a piece of paper palladium, gold, and silver. You don't see the actual price, although they do need to be pretty close to that, or the whole scam would be, I shouldn't say scam. The whole system would be adjusted, because if you're putting out a spot price of X and the true cost is 20% above that to actually get the metal, then the system would come into scrutiny at a huge level. And it doesn't, because they do adhere to pretty much the paper price, although there are fees and stuff on top of it. But I think it's such a small market they could control it for a while. There's no real urge for platinum to be used as a money substitute, or as money, really. I shouldn't say substitute. Gold and silver are money. And platinum classically is money, but no one thinks of it that way, not even me. But I just do it because of, as you said, 70-80% in one place. That one place looks like it's on the downstroke, not the upstroke. It's being used for more. This idea using platinum for the hydrogen economy may or may not take hold, but there's a push that way. And if you can buy any commodity, corn, rice, wheat, oil, under the cost of production and have some patience, you almost always make money.
Just to close up then, you've been very generous with your time today. I heard you say in a recent podcast that you don't buy into the idea of a commodity supercycle. So in other words, I guess you think there are some lame ducks in the commodity space. So my closing question for you today then is, if you were the manager of a commodities fantasy football team, which three commodities would you choose as your star players, and which three would you leave to kind of sit on the bench?
Well, I take something out of the precious metals complex. I take something out of the agricultural complex, and then I'd pick something out of the softs, maybe coffee or cocoa. So, I don't know which those. I know foodstuffs in general go up. I just put out an ETF that kind of does a conglomeration of like oil and food. It's sort of like a really good hedge for stuff we need. I mean, commodities are needs. They're not, wants. I mean, you might want to own Tesla, but your life doesn't really change other than your financial condition. But you need to eat. You need to have cotton to have clothes. You need, you have to have your coffee, whatever. So I would do foodstuffs, metals, take your choice, and one of the softs. You can go with I don't know, cotton or cocoa or coffee. It doesn't really matter to me. I wouldn't do anything in the financials. I'd do nothing in the T-bond, T-bill market. Some of the exotics I wouldn't touch. So just the basics, food and energy. I would do, let me reframe that. I would do agriculture, precious metals, and oil for long term. I think oil, even though it gets ripped a lot, is still paramount to run the world. And there aren't really many substitutes. I mean, the amount of solar and wind is minuscule to the amount of oil that's used. And nuclear is something that most people don't know, but 20% of the power in the US is nuclear based. And many of those nuclear plants are 50 years or older, and they need to be decommissioned. So what happens if you need a 20% increase in power and you can't build them fast enough to replace them? And the answer is the small nuclear reactors, the but those have gone kind of by the wayside now. So we've got an energy crisis coming, as well as everything else in the not too distant future.
I know the listeners would not forgive me if I didn't ask you, given that you raised the question nuclear, do you have any investments in uranium stocks?
Yeah, we've done well on the uranium side. In fact, I need to do an update for my subscribers and say, hey, maybe we should take something off the table.